Hi there, welcome to Rent Prep for Landlords. I'm Andrew Schultz, Community Manager here at Rent Prep. I'm also a real estate broker and property manager with over 14 years of experience in the rental property industry. Today we're going to be talking about the steps that you should start taking now to get ready for next year. Let's get to it. The first thing that I like to do when I'm starting to think about planning for the following year is to bullet list the things that I'm looking to either accomplish, acquire, or achieve for the following year. So for instance, next year, we've got a couple of big goals. We want to build a 30-foot by 60-foot shop building, which is on our accomplish list. We want to buy an articulating boom lift to make our exterior maintenance operations a little bit easier. So that's on our acquire list. And I want to get our company to a certain number of dollars per door on the management side of the house. So that's on my achieve list. Essentially, I have a few goals that I'm working towards in the coming year, and I have a broad sense of what I want to do to get there. You really can't know where you're going until you know where you've been. And I find that one of the easiest ways to help me at least figure out where I've been in the past year is to sit down with my calendar from the current year and flip back through the pages. Grab your calendar, grab your day planner, whatever it is that you like to operate from, just start flipping backwards through the year, and it's going to give you a real good indication as to a lot of things that you had potentially even forgotten about over the course of the year. It really hasn't been that long since the beginning of January, but we're always moving forward, and it's very, very easy to forget about things along the way that have happened. So spending a few minutes going back through your calendar, strolling down memory lane, if you will, it's a good way to help you jog your memory on things that you wanted to change or fix or improve that you either never got around to or just simply forgot about. Some examples of things that you could be listing for your following year for next year are maybe things like acquiring a new piece of rental property. That's a pretty good goal. That's definitely something that should go on your list. Something like acquiring a new piece of equipment, similar to what we're looking to do, changing your management softwares or accounting softwares, that's something that's a strategic goal. That's something that should go on a yearly list. Working with your bank to help you improve your finances, helping you to improve credit or something along those lines so you could finance your next project. Hiring a handyman or hiring a property manager. Those are all great things that are things that you should be thinking about now at the end of this year to get ready to do them in the following year. Start planning now for what you want to do in 2023. Not going into 2023 with some sort of a plan is basically setting yourself up for failure. I'm not telling you that you need to set New Year's resolutions or anything like that, but you at least need to have a good general idea of where you're at and where you want to go, and that's going to help you to kind of aim your efforts as you move forward. All right, so now that we have an idea of what it is that we want to do, let's start getting ready. We're going to start by talking off about the accounting and financial side of things, and then we're going to move on to legal. As a quick reminder before we jump into this, I'm not an accountant, I'm not an attorney. Rent Prep's not a bunch of accountants, Rent Prep's not a bunch of attorneys, and your situation will certainly be unique based on your circumstances and location. Talk to your local team of trusted experts before you make any financial or legal moves, and verify everything that you hear some guy on the internet tell you before you act on it. So no one likes to pay taxes, obviously. That's one of the main reasons that a lot of us are in the real estate industry, is that it does help to offset some of our tax burden. Fortunately, the tax code in the United States ensures that real estate professionals are well considered when it comes to tax deductions that you can find in the tax code. Pretty much everyone is going to pay some taxes at some point. The point is not to pay any more than you're legally required to. The absolute best advice that I can give you in this entire video is to start getting all of your tax information prepared as soon as possible and get it all in one place. If you're missing statements, if you're missing receipts, if you're missing documents from outside agencies, whatever it may be, the chances are it's going to take you a little bit of time to chase that stuff down, and finding that information, locating it, and getting it all in one place is going to make your life so much easier as you plan for your following year. It's also worth mentioning that if you don't have some sort of computerized accounting system, you really need one. It's 2022, 2023, depending on when you're watching this video. If you don't have a computerized accounting system that you're able to use to generate accurate reports at the snap of a finger, you're at a massive disadvantage in pretty much every area of your business. It's crazy to me that there are still people out there in 2022 and 2023 that insist on running a pen and paper ledger. There are obviously still people doing it, but you would never catch me doing it. It would slow the entire operation down not to have that in a digital format. From where I'm sitting, having a digital computerized accounting system just leads to way, way, way more efficiency once you know and understand how to use it. You really do need to spend some time learning how to use your software or hire someone that knows how to use the software and can get you the results that you need. I don't think I'm really shocking anyone here. I don't think I'm really rocking the boat by saying that you need to have a computerized accounting system at this point. If you don't have something like that in place, this needs to be on your priority list. This needs to be your #1 priority for 2023. If you're still trying to compile all of your paper records and receipts and everything the night before you go in to meet with your accountant, you're going to have a really, really bad time. While we're on the topic of accountants, it's probably a good idea for you to hire an accountant that knows and understands real estate transactions from a variety of different aspects. They need to understand how the taxes work around a real estate transaction and what can be done to help offset those taxes, such as your deductions, your depreciation, your 1031 exchanges, things of that nature. Sure, you can probably sit down and figure out how to do all this yourself, but do you really want to sit and thumb through all of that tax code? If you have a good accountant that understands the tax code and has a strong familiarity with real estate, they're going to understand how your business operates, and they're going to help you to find deductions that you may have otherwise missed. That could really help you to reduce your taxable obligation, which could help offset the cost of the accountant, could even pay for the accountant in its entirety, just by having them take a look at what you're doing and find some extra deductions. It's very, very easy for them to find something that you may have overlooked. Could save you big money to the point where your accountant is almost free because the deductions that they have found offset the cost of their services. The bottom line is that once you start getting into real estate investing, it really is worth it to have a good real estate accountant on your side. Something that you want to keep in mind is that the fact that you bought and flipped a home does not necessarily mean that you're going to be considered a real estate professional by the IRS. I'm not going to go into all the ins and outs of being a real estate professional by the IRS, but I can tell you that it does take some documentation, especially if you're not engaged in real estate as your full-time occupation. So if you're still working a full-time job and you just have a couple of investment properties on the side, you may have trouble qualifying. So from the IRS website, and I'm going to read this is directly quoted from the IRS website, a taxpayer qualifies as a real estate professional for any year that the taxpayer meets both of the following requirements. 1, more than half of the personal services performed in all trades or businesses during the tax year were performed in real property trades or businesses in which the taxpayer materially participated. And number 2, the taxpayer performed more than 750 hours of services during the tax year in real property trades or businesses in which he or she is materially participated. So if you think you may fall into one of these categories, I understand that that definition is about as clear as mud. Talk to your accountant about it. Being classified as a real estate professional definitely opens up a lot more opportunities and a lot more tax deductions for you as a real estate investor. So it's worth having that conversation with your accountant to see if that's something that you will qualify for. Now is an excellent time to start determining what your potential tax obligations might be and what options you may have in trying to mitigate them, trying to offset them. Essentially, you may want to sit down with your accountant and start looking over your financials, possibly even run a sample tax return for the following year and see where things are going to fall. Some examples of things that you might be able to do to help you reduce your tax obligation would be funding an existing retirement account, opening and funding a self-directed IRA, things of that nature. Also, if you're still employed full-time and your employer offers some sort of a matching contribution from your primary source of income, make sure that you're taking full advantage of that matching. Make sure that you are at whatever the point is that they're going to match up to. Make sure that you're at or above that to take advantage of the full offering, the full match that your employer is offering. One of the main things that is going to be looked at when you are determining your tax obligation will be all of the things that you've spent money on over the course of the year. Now, obviously, the goal here is to turn operating expenses into deductions, and the more deductions you have, the less you're going to wind up paying out to the IRS. Some good examples of deductible items would be repairs and maintenance on your property, landscaping, snow plowing, property taxes, property insurance, mortgage interest, operating expenses, travel relating to the properties, such as driving to and from the property, driving to and from the repair shop, things of that nature. Or if you're investing outside of your area, you can deduct things like airfare and hotel if you're flying to a new market to look to invest in. So there are some opportunities for deductions there above and beyond just what you have at the actual property level. There's also things like the home office deduction and probably every real estate investor's favorite tax deduction, depreciation. We could literally have episode after episode after episode about depreciation. Realistically, this is a conversation that you're going to want to have with your accountant. There are a lot of things to factor in when you're talking about depreciation, such as the lifetime of the asset, what the IRS allowance is for the depreciation of that asset, what are the depreciation methods you might be able to use to depreciate the asset, things of that nature. Even different projects at the same property could potentially be looked at completely differently. Something like repairing a broken outlet, that's going to get deducted all in the year where the repair took place. But something like putting a new roof on the property, that might wind up being depreciated over a longer term. Depending on the type of project you're doing, such as a full-scale renovation, you may even wind up getting into things such as cost segregation. Again, I'm not going to get real into the weeds on things like cost segregation, but in a nutshell, cost segregation is a tax strategy that essentially allows you to accelerate the depreciation on an asset in order to help increase your cash flow. So if you want anything more in depth than that, I'm going to have to send you back to your accountant because you can really get deep into something like that, and it's way outside the scope of our video. If you completed any sort of a property purchase or a sale or a 1031 exchange, anything along those lines, you're also going to need to make sure that you have all of the associated paperwork so that you can account for all of that. Your accountant's going to need the information from you, to help determine the property basis, how to best deduct and depreciate things, and so much more. So make sure that you're keeping track of all that paperwork as well. This is also an excellent time of the year to start thinking about making sure that all of your vendor information is correct. You need to make sure that you have not only correct contact information for your vendors, but you also want to make sure that the W-9 that you have on file is correct as well. At the end of the year, you're going to have to issue out a 1099 MISC form or a 1099 NEC form to whatever vendors you're working with if you paid them over $600. So making sure that you have those W-9 forms completed will make that entire process a lot easier. Then you'll have the tax ID number that you need in order to generate your 1099 forms. Assuming you have any money left over at the end of all this, it might be time to start thinking about other ways that you can reduce your tax obligation before the end of the year. You might want to look into some capital purchases that you've been putting off. Maybe if you have a roof or something along those lines that you know that you're going to have to change it next year and you have the money to do it now, maybe it makes sense to do it now and help to either reduce or eliminate some of your tax obligation. It's a very common tactic that you see a lot of companies use right up at the end of the year, where they will either purchase new equipment or a capital expenditure to help reduce an overall tax obligation. Another good way to reduce your overall tax obligation while still being a benefit is to complete repairs on the property. So if you have stuff that hasn't been a priority, or you have a project that was a maybe someday project, now you've got a little bit of spare scratch to work on it, this is the time to jump on those projects, because it helps you to eliminate a burden on your taxes while also helping you to improve the property, improve the quality of the property for both you and your tenants. The one last thing I wanted to mention here in accounting is talking about charitable giving. Obviously, not everyone likes to give to charity, but you may find that giving to charity will help to reduce your overall tax obligation. Now, listen, I feel like if you're going to give, it should be because you want to give and not because it's a tax deduction. That said, legally donating to a charity, donating to a legally recognized charity, does give you the ability to deduct the cost of that donation from your taxes. Ultimately, I think that we should be giving from our hearts and not from our balance sheets, but there is an option there to help you reduce that obligation. Enough about all that. Let's go ahead and jump into the legal side of things. So the first thing I'm going to recommend on the legal side of things is to review your asset protection setup to ensure that it's still protecting your assets. Now, if you're saying to yourself, I don't have any asset protection, then it's probably time to talk to your attorney and your insurance broker to determine what's right for you. For a lot of people, asset protection starts as simple as a property insurance policy and having a general liability umbrella above and beyond that. Most people already have that in place at the onset of their real estate investing, so you likely already have some sort of asset protection in place and didn't even realize it. From there, as your business grows, asset protection can also grow into a giant tangled mess of corporations, trusts, estates, LLCs, holding companies, operating companies. You get the idea. But taking a look at your current asset protection where you're at right now and determining if you need to make any changes or add anything to protect yourself is always a smart move, and the end of the year is a good time to do that before you go into the next year unprotected. We also just mentioned insurance policies. This is an excellent time to start taking a look at your insurance policies to make sure that they still cover everything that you need them to cover. Keep in mind that the past couple years were two massive years of growth in real estate. Property values increased, and in many instances increased by double-digit percentages in different areas of the country. And it's time to double check your property insurance to make sure that your property is still insured for what your property is valued at, to either repair or replace the property in the event of some sort of a loss. Keep in mind that all things in the contracting world have also increased substantially in cost over the past couple of years. Those two factors could lead to your insurance policy being insufficient in the event of some sort of a loss. There's actually a single-family house right down the road from where I live that had a fire back in the early part of 2021, and that was basically the peak of labor and material prices. And unfortunately, that property owner's insurance policy did not cover them for the full rebuild of that house. The home is literally still sitting there unfinished because the property owner, for lack of a better term, burned through all of their insurance funds trying to get the home renovated and turned back over so that they could move back into it. Don't let that happen to you. Make sure that you're protecting yourself by ensuring that your property insurance actually insures the property that you have. In addition to having solid property insurance to protect yourself, you should also have a solid lease. These past few years have seen a lot of changes to the legislative landscape, especially when it comes to landlord-tenant law. And regardless of whether you want a one-year lease or a month-to-month rental agreement, you really should have a really solid lease document reviewed at least once a year by your landlord-tenant attorney. And again, this needs to be an attorney that understands landlord-tenant law, preferably somebody who also understands how evictions work, and should review your lease document to help you make any necessary changes to stay compliant with your local, state, and federal laws, as well as fair housing law. Now, I know that once Thanksgiving rolls around, at least here in the Western New York region, it seems like the real estate world comes to a screeching halt until after the holidays. I don't know if that's something that's exclusive to our area or not, but I would suspect that it's probably not. I think that people probably start to ease off the gas a little bit after the holidays. And we find that once Thanksgiving hits, everybody starts to take it easy basically through the end of the year. If you have legal matters or transactions that you need to square away before the end of this year, start pushing as soon as possible to make sure that you don't wind up pushing those into the following year. You may even take a look at a deal and determine that it makes more sense for you to either pull that deal forward or push that deal back before the beginning of the year or after the end of the year, depending on how that would impact your financial obligations, your tax obligations, and things of that nature. Now is the time to start looking at all of that and making those decisions so that you can be in the right place when December 31st rolls around. So there you have it. That pretty much wraps us up on everything having to do with end of year planning. So there you have it. Get that end of the year planning out of the way now so that you can enjoy your holiday season and be ready to rock and roll in 2023. Is there something that you do every year that we forgot to mention in our video here? Do us a favor and drop us a comment down below and let us know. Don't forget to like and subscribe. Thanks for watching. I'm Andrew Schultz with RentPrep.com, and I'll talk to you soon.